What if your Airbnb side hustle could be the key to saving thousands on taxes? This episode will break down the short-term rental loophole that business owners don't even know exists. Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal, hosted by Anastasia, Myiesha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy, we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
Welcome to the next episode of Let's Get Fiscal. This time we are going to talk about this short-term rental loophole that everybody is talking about. So I'm sure you guys have heard about it kind of on TikTok and Instagram. Yes. And things like that.
Mm-hmm. Yeah. So, not a lot of info though. So yes.
I know. And I hate when they call it a loophole when it's specific things that are written into the IRS tax code that they want you to take advantage of.
Yeah.
So it's not really a loophole. People just use that as like,
buzzwords.
Exactly. So short-term rental, obviously, you're going to be purchasing a rental property or managing a rental property in some type of way. And one of the terms is real property.
Okay.
So real property is a house. Personal property is like your computer and your cell phone and things like that. So I know sometimes when people hear like real property, I mean everything.
All of it's real. Yeah.
So we're talking about homes or condos, but living spaces specifically. Okay. So we want to keep that in mind that it's
for rent.
Okay.
What makes it short-term versus, I guess, like long-term then? Like what is the difference there?
So a short-term rental, the average stay for throughout the year has to be 7 days or under.
Okay.
So that's why Airbnb is so great because most of the time people are going for a weekend, a 3-day weekend, and it doesn't have to be every single stay has to be under the 7 days. So it's okay. If somebody stays for 2 weeks, that's perfectly fine. But if you take all of your stays throughout the year, you make an average of them, it has to be under 7 days.
Okay.
Versus a long-term rental, normally those are going to be the ones that have a lease for a year or more.
Okay. That makes sense.
I mean, even there's some cities, especially now that people are cracking down on Airbnbs, that they require that you sign a lease for 30 days.
Oh, okay.
So long-term rental could also mean as little as 30 days. But for the IRS, it's going to be 7 days or less gets you into this really good sweet spot of the short-term rental.
Okay.
So I think kind of stepping back into what some of the differences are. So a long-term rental, normally they have a 1-year lease. So you find a tenant and then you sit by the mailbox and once a month they send you a check.
Yes.
Of a short-term rental.
No, for a
long-term rental.
Yeah.
Okay.
So they call that passive income because once you find that renter, your job is basically done. I mean, you still have to maintain the property and whatever, but you could easily go off and do other things. Or like I said, in some cases, you could have a realtor that's doing all of that management for you. You're just sitting in your rocking chair collecting checks.
Yeah.
And so that's going to be considered passive income. And the IRS is really particular about different types of income. So it's kind of like oil and water, so your passive income interacts differently than what we call your earned income. And your earned income is the money that you make from your W-2 or from your business.
Okay.
So when we get into the short-term rental, now, like I said, the average stay is normally under 7 days. So that means you're probably putting in a lot more work into it.
Okay.
So at that point, the IRS says, hey, this isn't passive. You have to do a lot of different things in order to collect this money. So this is actually going to be considered a business. So now it's kind of floating in that earned income section. So if you have losses, you can apply that against your other earned income to decrease your taxes overall.
Oh, okay. Do they have to be related to expenses for the short-term rental? Like, is that normally hand in hand?
So right. I mean, they're going to be, so the short-term rentals and all rentals generally are going to be cash positive, but tax negative.
Okay.
So because you think when you pay your mortgage, so you purchase the property and you're allowed to depreciate it, which means you are taking a deduction for your use of the property over the whole life cycle. And that's for the full purchase price. And they don't care if you take a loan because technically you're buying that house in full on the day that you close. So you're able to depreciate 100% over a certain time frame. So you get that. But then also you have your mortgage, and layered in your mortgage is the interest, property taxes, and insurance. So you're also able to deduct all of that. So if you're running an Airbnb or short-term rent or long-term rental, you're able to. So if you're running a short-term rental or a long-term rental and you're just covering the cost of your mortgage, technically you're always going to have a loss on your taxes because a lot of those first few years of your mortgage are going to be mainly taxes, interest.
Yeah.
Plus you have the depreciation, which is more than what you're putting towards the principal of your mortgage. So you end up creating these losses. And then you also have the cost of the management of the property, any of the supplies. If you're doing an Airbnb, you have furnishing the property, you have maintaining the property, the landscaping, pool, all of that stuff kind of comes into play. So a lot of times you can be making money and able to cover all of these items. But when you go on your tax return, you're actually kind of losing money.
Okay.
So if you have a long-term rental, that goes under passive income. And if you make more than $150,000 on your W-2, you can only deduct up to $25,000 of passive income against your W-2. So for a lot of our high income earners that are able to just purchase a second property these days and have the means to do that, they're earning more than $150,000 a year, so they're not able to deduct anything. That long-term rental is going to continue losing money every single year. It doesn't do anything until you sell the property, which can be a little bit tricky because, I mean, I've had clients that decided to buy their childhood home. They are never going to sell that home. It's just not going to move anywhere. So they're accumulating all of these losses that are going nowhere. They're not benefiting them. And I mean, granted, they are able to cover the mortgage and things like that, but still, they're not getting a lot of that benefit. Once we switch over to that short-term rental, we don't have an income limitation. You can just have the losses and they get deducted against your regular income.
Okay.
So when you see things that are like, oh, I saved this doctor like $1 million in tax, it's because they purchased a property, they put it on Airbnb, and now the property is losing money, and they're deducting it against their W-2.
Okay. That kind of makes sense to me.
Do you think?
So it is a good idea.
Yes. Yeah. So like for the case where they bought their childhood home, and does it matter who stays at the home? Because I know the average has to be the 7 days, but if they don't want like a lot of people in their home, like how strict are they? Do you know about like the short term?
So there is the property mainly has to be for that business purpose.
Okay.
So you could still use it for your own personal use.
Yeah.
But you only have a maximum of 14 days or 10% of the time that it's rented, you can use it for yourself personally. Anything more than that, you have to basically get the percentage of how much did you rent it versus how much did you use it And then all the big things like interest and property taxes are going to be, allocated based on that percentage.
Okay.
So if you rent it out on Airbnb 50% of the time, and then you use it 50% of the time, you're only able to deduct 50% of the interest.
Okay. So it does matter too how much you're using the space as well. Okay.
And even like you said, like family members, things like that. Anyone that is close to you that you are offering below market rate.
Okay.
So as long as, you're charging your grandmother exactly what you would charge everyone else, then you're fine. But, if she's staying there for free because you have like this beautiful home on the beach, then that's going to count towards your own personal use, even if it's not you in particular.
Okay.
So that is something that you do have to be a little bit aware of. So it is mainly going to be a building that's for business use.
Gotcha. Okay.
So, sometimes like you said, you can have a vacation home that you're using, and you can use it part of the year, but you do have to, plan accordingly for that.
Okay.
So what's kind of fun and really where they get a lot of the tax savings is when you do a cost segregation.
Okay.
Because again, you have a lot of income, you're taking money, you're putting it towards a house. Even if, let's say, you fully furnish the house and you have taxes and insurance and everything, you might end up with a $25,000 loss or a $50,000 loss. But if you're making $400,000, that's not going to necessarily help you. So in order to not end up purchasing, having to purchase 10 homes or what have you and have like this really huge portfolio, what you can do is called a cost segregation. When you have that short-term rental and even a long-term rental, the idea is the house is there for a really long time. So if you're separating out every year and you're only deducting kind of your use for it for that year, sometimes it can be a very small amount. And so for a regular property, that's going to be around 20 years. But because you have the Airbnb, it's considered a commercial property. Even if it's a residential house, the IRS is going to consider it commercial property, which means you have to depreciate it over 30 years.
That's
so
cool.
You're getting even less of a deduction on your depreciation when you convert it. So I don't like to wait for things,
Okay.
I mean, who can wait all those years, literal decades in order to fully get the benefit of this property? So what we like to do is pair it with a cost segregation. And the cost segregation, an engineer goes into the property and actually breaks it out into its separate pieces. So they'll tell you how much the driveway costs, how much the lighting costs, how much the kitchen cabinets cost. They really break everything down into its individual components. And when they do that, it creates different types of assets. So that turns some of those items, instead of 30-year property, into 5-year or 15-year.
Okay. I see.
So we're shortening that timeline, but also you can claim some bonus depreciation and things on it.
Okay.
So things like Section 179 and bonus depreciation kick in. You can grab basically 100%, sometimes 80%, whatever, depending on the year. But you can grab all of that depreciation in the first year when you purchase the property. And sometimes that in your tax savings is basically your down payment for the house.
Okay.
So, I mean, if you can save $50, $100, $150,000 in taxes, basically you're paying yourself back what you put down as a down payment for the house. The house is paying for itself, ideally. But also you have a house at the end of it.
Yeah. Yeah.
So again, it's one of those situations where you're still technically spending money to save money, but that money is already gone. The IRS has already earmarked it. So let's use that money in a way that actually benefits you. And that's that short-term rental loophole. Right. But
wow,
there's also strings attached.
Okay.
Right. I had a feeling.
Yeah. I was like, this sounds a little too good to be true.
Easy.
Yeah.
Okay.
So there is something called material participation.
Okay.
So even though the activity itself is considered a business activity, you have to show that you're actually working in the business. So
how do you work in your short-term rental? How do you do that then? Yeah.
I mean, so some of it is you are working on the financials, you're scheduling people, you're scheduling the cleaners, you're working with the property manager, you're doing site visits, you're repairing the property yourself.
Okay.
But all of that has to be heavily documented. And you should be keeping a time card of how much time you are spending on the property.
Interesting. Okay.
So it's really your second business.
Right. Okay. Exactly. So it's not like you can just randomly buy a house and then they'll do that. It does take a bit of work and responsibility in order to do that, and you have to be able to show it. So the other alternative is to be considered a real estate professional. But as a real estate professional, most people aren't going to qualify because that has to be your main position. So somebody who is a doctor is never going to qualify for a real estate professional because
they're a doctor.
They're a doctor.
Yeah.
Right.
No,
that's their main thing. If they decide to retire and focus on the properties, then we can start talking about a real estate professional. But for the most part, we're able to still get the benefit. We don't need to be considered a real estate professional. We just have to show that material participation. Okay. Some of that is 100 hours a year you have to spend on the property.
Okay. And that's not too
it's
much.
2 hours a week that you spend on the property. And it could be maybe, 8 hours one day or, it doesn't all necessarily have to be in this regular structure. But for somebody who is working a really demanding job, like a doctor, the IRS is going to say, I mean, how do you have time to even sleep and eat and, all of these things? So that's where that documentation comes into play. Or maybe you have a spouse and they're, doing that. But then you also have to be even more careful because let's say you have enough money, you do the down payment for one property, then you do the cost segregation. It's earning money. You have this extra cash. You can roll it into another property. So now you have to worry about material participation, 100 hours at each property.
Okay. It's an each thing. Okay. Not an overall portfolio thing. Yeah.
You can ask for them to mold it all together.
Oh, okay.
And join it as one activity.
Okay.
But some of those there's different reasons kind of why you would or you would not do something like that. But you just kind of have to know.
Yeah.
So that's why I always say, I mean, people like to say that it's a loophole. It is relatively easy, but you have to be aware that there are still responsibilities attached. And that's why the IRS is allowing it, because it's not easy, free money. I mean, if you've ever dealt with somebody with a complaint, it is not going to be the easiest thing that you do. And especially people messaging you all times of the day. And even if you have a property manager that's doing a lot of that work for you, I've had properties that had their whole entire basement flooded.
Yeah.
So there's still a lot of different things.
It's a whole nother house that you have to maintain.
Exactly.
It's a lot of work.
But I love it as a great strategy if you're looking for other investment opportunities. Especially if you want to own multiple properties, you want to diversify your portfolio, you have a little bit of extra cash.
Okay.
I mean, if you're going to spend $100,000 on it, again, maybe, you've maxed out all of your retirement, other things
Yeah.
are kind of kicking in, and you've already bought everything that you could possibly buy. This is a
maybe
really
do
good
this.
way
Yeah.
to do it.
Mhm.
So one of the things that you have to be careful of, though, is, like I said, you have to do the cost segregation. You have to make sure it's from a reputable company. They send out a knowledgeable engineer. They send you a huge report that shows you all kinds of information about the property, pictures, details everything out. But also you have to look at the county assessor's website.
Okay.
So this is kind of where I come into play a lot, is in the decision of whether or not, not necessarily an accountant, but a tax strategist.
Okay.
So you have to make sure that you're identifying the most viable property. So when you think about depreciation, a majority of that depreciation is going to come from the building itself.
Mm-hmm.
And then the rest of the purchase price is you're paying for the land. So in places like Los Angeles, land is actually very, very expensive.
Mm-hmm.
And it could consist of 70% of your entire purchase price is actually going to the land. And there's not a lot that you can do to depreciate it. I mean, if it has a pool, if it has a deck, maybe there's a little
something there. Yeah.
But not as much as if 70% is the actual house itself. So you really have to pay attention to the areas that you're choosing. You have to look at the county assessor's website to see what is the value of the land versus the building.
Wow. Oh, interesting.
And that's going to be one of the easiest ways, because the assessor goes in when they charge you property taxes, and they say, okay, here's the assessed value of the building. Here's the assessed value of the land. It's most likely not going to be the same as a purchase price, but you get that percentage.
Sometimes you say things and things just click inside of my head. And this was one of those things, because it just clicked in my head. Why are property taxes so much? And it's because we live on a lot of land, a big lot, and even though our house isn't, a grand house, it's because we have a larger lot.
Right. And it all depends. I mean, a lot of times property taxes are used to fund the schools and, local systems around.
But I'm not complaining.
This is at least another way for me to read that notice we get every year about our house. Because I look at it and I'm like, I don't think I need to do anything here. It looks like our property increased in value from the prior year, because they show you all those things.
Yeah. How much of our house is... how much we paid for our land versus how much we pay for our house.
I don't know. Sometimes I feel like that's a slippery slope. Like when you look at your mortage payment and you see how much your money is not actually going towards principal. So it's like, do you want that knowledge just yet? No. Yeah.
But it is something really, really important when you are looking for a short-term rental property. Because, like I said, there are certain situations where it's a childhood home. You're going to have that property regardless.
Interesting.
But if you're really looking for a particular area, you want to be able to compare. Maybe you want to have it in Texas or Georgia or California.
Or in a city as opposed to a countryside.
Right. It'll have different land and building valuations. And you have to make sure that you're accounting for that when you're planning, because you're not going to be able to depreciate 100% of that property. It's just never going to happen. So when you are starting this entire process, that's one of the key items to keep in mind, is what is the land and building valuation. And then from there, you can start doing some rough percentages of how much of the building can you depreciate through that cost segregation, and then use that against your effective tax rate to figure out, okay, how much of this purchase price is it going to actually affect on my taxes? And with some of that information, I can say, okay,
it's worth it.
5% of whatever you're paying, that's going to be, basically your savings from, the cost segregation in that first year.
All right.
And so a lot of times it's only going to be those first few years where you'll have that huge windfall of the tax savings. But like I said, a lot of times you're able to use that to continue rolling it into other things if you're really serious about renting and you're wanting to take on, a lot of the responsibilities that is a short-term rental.
Okay.
So does it make sense that if you were in the like, hey, I think this is something that I want to do or something like that, that you would almost work hand in hand with your tax strategist and a realtor to get that information? Is that typically how that would be? It's just okay, I'll get this info, provide it to the tax person, make sure that makes sense before you would want to put an offer. And is that typical then? You would work hand in hand? Okay.
Yeah.
Okay.
Because the realtor a lot of times will tell you what the market value is.
Mm-hmm.
So what is the Airbnb market in that area? What is the average dollar amount that you would be able to receive from that property for each stay? How often do you think you'll have someone in that property? And is that enough to cover the mortgage? Because that's always when you're talking about rentals, you want to make sure that you're earning enough cash to be able to cover that mortgage month to month.
Yeah.
So
would it make sense to get the tax benefits for the first 5 years and then sell the house?
So
that sounds like a no.
So there's another string.
Yeah.
Right.
Okay.
Right.
What's the other string?
There is another string. Anything that you take off of your taxes, you have to add back if you get anything for it. So if I depreciate my property by $50,000 and then I sell it, the first $50,000, I'm going to have to pay tax on that.
Okay.
And that's true even when we have a personal home that is used partially for business use and you have a personal home exemption, you're still going to have to pay back that business portion that you deducted.
Yeah.
And then your personal home deduction comes into play. So in this case, you have to pay back all of the depreciation and then long-term capital gains will kick in. And so capital gains are normally taxed at a lower tax rate than your normal tax rate. So again, you kind of have to layer in how you're going to maneuver and what your strategy is with the properties.
Okay.
And then also if you're kind of flipping properties, then
that's different.
Yeah, you're
different episode.
Yeah. Okay.
All right. So, I mean, a lot of the things, a lot of people say it's a loophole, but it really is not a loophole. It's just a different type of business.
Right.
So you could have a laundromat.
Right. Anyone can do it. It's not a trick. Right. It's just another
and you
still
business. You still have to work in it.
Right.
It's still going to take time out of your day. So sometimes when people say, oh, I have a brand new baby, I want to do Airbnb. I'm like, well, maybe you don't want to. Maybe you want to wait a little bit because it's gonna add some complications. And that's the reason why you get the deductions, because there are complications that kind of come into play because you have to show that you are actually working in it, because otherwise you're just a little grandma collecting checks at the end of the day.
But if you have an Airbnb, like let's say you live in Iowa and you have an Airbnb, in a beach city in North Carolina, can you do that? Okay, so it doesn't really matter where it is?
No. It matters on the state side.
Okay.
So you're adding an additional state to your tax return.
Oh, yeah.
Because the property is in that state. So the income it earns belongs to that state. Oh, yeah. So you have to consider, how complicated do I want my taxes to get?
I forgot about that.
But again, for the most part, a lot of the properties, they end up losing money because they'll earn cash, but lose money on taxes. So the only other kind of workaround that I think is fun is having like a long-term rental, and then you find something that we call a PIG. So a passive income generator. And basically your long-term rental is going to create losses, but you have another investment out there that's earning money. And then the two of them zero each other out.
Okay.
So, I mean, you are still earning money and increasing your investment portfolio, but you aren't affecting your W-2 in any way. So it really kind of depends on which way you want to go. But for the most part, when you see that they have a big W-2, they saved a whole bunch of money on taxes, it's a short-term rental paired with a cost segregation so that we can accelerate that depreciation as quickly as possible. And then you get all of those tax savings. But again, you have to prove that you're actually working in the business. Yeah. The only other alternative, like I said, some of the cities are really cracking down because they don't like everybody coming in and out.
Right.
You know, it can sometimes affect the neighborhoods. And,
definitely.
Yeah, especially
they are cracking down. I noticed. My neighborhood banned them.
Right.
Really?
Right.
Yeah. Ours hasn't done it yet. There's quite a few that keep purchasing our houses to then rent out to others and all that.
Well, our HOA did.
So what you can do is if you're over the 7 days, you have to be able to provide extraordinary services above and beyond the normal service level.
Oh, okay.
So, for example, a person owned a property by a lake, and part of the rental of the cabin was fishing lessons.
Oh.
Or you're like taking them on a guided tour.
So it's another service.
Right. You're running more of a hotel or or a bed and breakfast.
Okay.
Where you're providing them breakfast, you're cleaning their rooms every single day, all of those things. Sometimes you can start talking about even if the stay is a little bit longer than the 7 days, you can still take some of the deductions. But again, that deduction is available because you're spending so much time and effort that it is legitimately a separate business at that point. So,
So if you're a business owner and you're looking for your side hustle of your loophole of opening an Airbnb, it's not a side hustle of a loophole of an Airbnb. It's a whole nother business of opening an Airbnb. So, so
right.
Yeah,
so
I don't. So it sounds worth it. And sometimes it sounds like it's not really worth it. So,
right. And that's where
for the taxes, it's worth it. Yeah.
I don't think I'd mind being a little old lady, though, collecting checks, like sitting in a rocking chair.
Yeah.
Not bad, too.
But if you have already another business,
true. Yeah. If it benefits overall the whole thing, it makes sense.
If you have the time and energy and
like I said, if you're married and your spouse has a less demanding position, sometimes that is a little bit helpful.
That's cool. You can use the spouse
so
too.
you can use your spouse or your children. Can you not your children? Okay.
I would keep it to the spouse.
Okay.
But like I said, the IRS is going to scrutinize scrutinize the situation, especially if they know that you have a really demanding job. And they know that because, number one, you say what your occupation is on the tax return.
Right.
They know your employer and they know how much money you're making compared to the average person. Right. So they kind of already have an idea of how much free time you actually have available to take care of these properties. So, I mean, I think it's still a great investment vehicle. I mean, a lot of times it's hard to know if you want to put it into 401k or a SEP IRA. Sometimes people just like a physical item that they can go back
I'll think about it.
But like I said, it's not necessarily a loophole. It's completely written into the tax code. It's all available for anyone to do. You just have to be aware that there are additional responsibilities that are going to come with it.
Okay. It's really cool.
Yep. So I love it. I think they're a great way to save a decent amount of taxes and really diversify and spread out some of your business income. But again, it's just making sure that you're mindful of the situation, you're recording your hours, and you're working with a tax strategist to make sure that you are following all of the regulations that are going to be required of you. Yep. Yep.
Okay, thank you guys for watching. That concludes our episodes. If you have any questions or comments, or if you would like to have a consultation with Anna, you can reach her in the link below in our show notes. Thank you, and we'll see you next time.
Bye.
That's a wrap on Let's Get Fiscal.
Ready to stop guessing and start saving?
Click the link in the show notes,
grab your consult, and let's make your business work for you,
not the other way around. You've got this.